Good morning, Sarah. Can you hear me?
Yeah, sounds good.
Okay, and how about my screen? Can you see my screen?
Perfect.
Can you guys see my screen?
Yep.
Yeah, we can see your screen.
Great. Good. Okay, well, good morning, everyone. Thanks, Sarah. Before I start on my regular market report, I do have a couple other announcements, partnership announcements to share with you guys. First, I want to talk to you about Easy Knock. I believe we have a meeting scheduled for this week. Sarah has already sent out emails. We'll send out another reminder. I just want to tell you a little bit of background about this company quickly. Easy Knock provides sale leaseback options to the consumer. This is a new trend that we're seeing in our business as very popular. There are a number of reasons people would consider a sale and leaseback option. You know, in some cases, they haven't identified the next property they want to purchase, or there's timing issues or family issues or market uncertainties. This company basically buys back the property from the sellers, you know, offer them market value, and then they can lease it back up to 12 months. What we like about this program, you know, Heidi and I talked to several people at Easy Knock and the other brokerages that they've used the program. What we like about it is that a seller can actually market the property in the open market on MLS, and they keep the upsell. So if Easy Knock offers you $100,000 and you end up selling the property for $110,000, you get to keep, the seller gets to keep the difference for the property, which is a great program. Again, a movement to keep an eye on. You're probably going to hear a lot of new players getting into this market. I know Invitation Home has plans to start the same program by end of this year. So please register. I think it's a program you're going to find it really, really interesting and useful for this market. The other partnership program is the Realtor Partnership through OpCity. As you know, there are a lot of lead referral programs out there. It's very, very popular now as leads are getting more expensive, and realtors have to spend more time to scrub the leads and find the real potential clients out there. It's just getting harder and harder for the companies, for the portals to sell those packages. So now they're developing a larger ISA team, scrub the leads, and making live transfers to agents in exchange of a referral. So this is really not that different from any other referral program out there, you know, HomeLight or Zillow Flex. The difference is, you know, all these programs, they have a different way of distributing the leads. So Sarah has something on schedule for I believe 26th or 27th of July. Again, we're going to send out emails to everybody. We'll include it in the chat box. Make sure you register. This is a free program. If you receive a lead, you pay between 30 to 35% referral fee. Again, these are live transfer leads and hopefully much better quality leads. So that's for our business partnership. So we're going to dive in to the housing market. Housing market is still great. I've got nothing but great news to share with you. 22% appreciation year over year. American home equity is skyrocketing. That's what Hadi mentioned. You probably know a lot of people you may want to check with and let them know the status of the market, how much money they have, how much equity they have in their house. I've got a slide to share with you, really interesting slide, showing about $34,000 equity gain just in 2021. So if somebody bought a house, average price point $350,000 in January, they've already gained about 10% equity in additional equity in their house. So that explains why the market is very hot and why we have so many buyers out there. Despite the price increase, the buyers are not completely discouraged. Current average equity of mortgage homes in the country is over $200,000. Really, really strong numbers. And you can see 38% of all the homes in the United States are free and clear of any mortgage. So our industry overall added about $1.9 trillion in equity. And again, these numbers are really strong. It explains why real estate is center of attention, why there's so many investments in real estate business. And with that, you know, I want to talk about the perception and reality. And we all know that, you know, perception is not always reality. And what people see about the market, it can be a little different. I'm sure if you run into friends or family members or people that they know you, they think that you're probably killing it in this market. It happens to me personally. They think realtors, they're killing it in this market. Every time I talk to a friend, you know, I see somebody that I haven't seen for a while, the first question they asked me, must be great for you. The business must be really hot for you. I mean, the business is great, but not so fast. Not everybody is making a killing in this market. And there's a lot of misperception, as I said, in this market. I don't know how many of you know Brian Buffini. Is a well-known coach in the real estate business. What he does is twice a year, he has his bold predictions. It comes out about an hour. He had one done last month and invited the Mr. Yoon from the NAR, from National Association of Realtors, and they kind of reviewed the 2021 membership profile. Very, very strong information there. I shared this on the company newsletter. I know there's a lot of text for you, so I try to pull out some of the important numbers to share with you. Look at the membership and what happened to the membership. In 2019, we have 1.4 million realtors. And that quickly, we added about 800,000, people, 1.48 in a short span of time, just 1 year. And look, we added more realtors. This is one sector of the economy, I guess, that we had no supply chain problem. We keep putting more realtors in the business. So from 1.4, we went to 1.52 million real estate, a quick jump in a short amount of time, and people that they're getting into this business. And here's a quick look at the historical numbers for the membership count. You see that in the year 2000, we had less than 800,000 members. 2007, there was a spike, 1.3, and then after the crash, the membership went down again to under a million members, and now today is at one of the highest, 1.5. And the problem with increasing the number of agents in the business and realtors is that the transactions per agents are not going up, and the average income per agent is going down. So look what happened to the median realtor income 2019 versus 2020. It was $49,700, and that number came down to $43,000 in 2020. And I expect those numbers actually to be less than that for 2021. Average number of transactions also came down from 12 to 10. But why we have all these people come into the business, what's happening? I mean, obviously the money is enticing, but if you do a little bit of research online, you find it really interesting how many articles, how much information, wrong information is out there about real estate. This was one of my favorites. I found it online, and I wanted to share with you just to see what is happening, how little people know about our industry. And I'm just talking about the general public. This was something that was published on one of the real estate sites, companies that they're offering classes. This business basically has few barriers to entry, low startup cost, in comparison to somebody that is going to a college. Looking at these numbers, basically it's showing that it only costs you $1,000 or $1,200 to get a real estate license. But if you want to go to college, you have to spend about $57,000. So a lot less expenses to start in the business. And, you can quickly be up and running. But these numbers are deceiving, as you guys know, as the experts in the business. The reality is different. The reality is that probably about 75% of realtors, look at these numbers, 59%, less than 10,000, 15% of them, less than 24,000. If you look at these numbers, you add up these numbers together, 75% of all the people that are getting into the business make less than $25,000 in 2 years. And that's why they leave the industry. If after spending 2 years in the business, they're only making, $10,000 to $20,000, no wonder why they're leaving the business. That's why we are hearing from the experts that this industry, is a really tough industry. People get in, 80% of them don't make it, and the other 20% can survive. But then the other number is 54% of all the realtors make less than $50,000. So it's not as glorious as the public think and the people think about this business. Again, some numbers here. I'll share all these stats if you care to study and know the demographics of the people in your business. But average agent in the business for the first 2 years, they only do 3 transactions. That explains it. Real estate occupation for most of these people, 63% of them, that's the only business they have. So that tells you that 1/3 of these people, they keep their day job, which is good. I guess if 80% of them don't make it, it's good that they're not going to quit their job right away. So interesting numbers about our real estate. Now we're going to dive into the mid-year market report and see how the markets are doing. Overall, sales contracts and purchase contracts are up everywhere in the country. And, we have inventory problems. We hear about that a lot. but at the same time, you see that sales are going up. There's more realtors selling the homes. That's why the transaction per agent is going down. But overall, United States, 44% increase in total number of transactions. The South is about 47%. So we're doing better than the average. But the West, that market was kind of shut down for a while because of the pandemic, and they were really affected. So now this year, you're going to see bigger growth in that market in comparison to the other markets. Existing home prices, 23%. This number is unreal. This is year over year. If you look at the average price of homes, this year versus last year, you can see the South has 22%. That's our market. In some of our markets, we see 25% increase in property value in 1 year. And this is an interesting chart from American Enterprise Institute showing that the homes that are in the mid price point and the higher price point actually had a bigger jump in property valuation. So looking at, low to medium, anything under 350,000, 15% appreciation, but higher price point properties, they had actually more appreciation, up to 25%. Clearly, this is a seller's market. Just looking at this graph, anytime that you have less than 6 or 7 months of inventory, you can identify that market as a seller's market. And today we're operating about 2.5 months of inventory. So definitely we're in the seller's market territory. As Hadi said, this is not going to change quick. But good news is that every one of the states, every market in the country is seeing some improvement in the number of inventory. The blues that you see in this map, this is all growth of inventory. And so the only markets that are really, really slow, South Carolina, Florida, Alabama, Mississippi, and New York. But the rest of the country is adding about 5 to 10% more homes. And here's a chart to show you that. In December, we had the lowest level of inventory in the country, and slowly coming back up. Quickly on the job market, we have recovered about 70% of all the jobs that we lost during COVID, 15.6 million out of 22 million jobs. So we're still short about 6.8 million jobs. And if we can add another 800 to a million job a month, so in a year, we shouldn't have any job problems. But we all know that some of the people that they left the job market, they're reluctant to come back, especially in the food and service industry, in the hospitality. There's still, health concerns, and I think it's going to take longer time to get those people back. But overall, the numbers, looking at unemployment rate in June was 5.8%. A year ago, same time, unemployment was over 11%. Great numbers for our economy. We are doing much better in North Carolina, South Carolina. Look, we are actually below, the unemployment rate is below the national average rate, 4.9%. Almost at the same rate that we actually were before pandemic. And in South Carolina, 4.5%. 2.2 million people, they're actually working. So that's just to give you an idea. In South Carolina, we have about 3 million people over age of 25 that they're basically eligible workers. So that's a really good number, a strong number for South Carolina market. So what to expect? The big news on the media last week was about how much realtors are going to make this year, right? The expectation is that residential real estate agents are going to make about $100 billion in commission. That's a big number. It's getting a lot of attention. That means that we're going to continue seeing a lot of venture money coming to our business. A lot of people are try to enter the real estate market and disrupt it even more, because now we're showing $20 billion more income than 2020. Strong number for real estate. Home sales are expected to continue to grow. The numbers I have here, it includes the existing home sales and the new construction. So 6.7 million basically is what Fannie Mae. These are 3 different institutions that they basically can have their own projections between 6.75 to 7 million for 2021 and 6.5 to 7.5 for 2022. So, strong market definitely for 2021 and 2022. Home prices will continue to grow. Everybody has different opinion. Again, I have Mortgage Banking Association 10%. NAR expects another 9% growth, continued growth for the second half of 2021. So, if that really happens, we're going to see about 30% price increase in certain markets. In Fannie Mae 8%, FreddieMac 6.6%. Mortgage rates will remain low. There's no expectation. I don't think we're going to see a spike before the second or third quarter of 2022. What to expect quickly as a buyer? It takes time. It takes longer to buy a house in this market. Average 96 days. You have to tour about 14 homes and probably make about 6 or 7 offers. Buyers are getting ready to pay more money in due diligence and down payment. That's the market is dictating right now. And if you're a seller, you're probably getting about 5 offers on your property. Average days on the market 17, down about 10 days from last year. Looking ahead, what do I think is going to happen? What are the things to watch for? Mortgage rates will remain low through Q3 2022. Inflation rate may force some of the buyers out of the market, so that will probably adjust the market a little bit. Expect rent prices to go up. Rents is not going to go down. We're expecting it to continue going up in the next 5 years. We have an underbuilding gap of 5.5 million homes. I mean, that's what Hadi mentioned earlier. It's going to take a long time for us to get back to normal. And expect continued inventory growth in most of the markets. And expect some price adjustments. So I just want to show you a quick slide in MLS and Canopy MLS. If you look at the properties that they had price reductions, you can see that either agents are not doing a good job as far as pricing the properties, or sellers are actually learning that they have to adjust and price the property right. But the prices, this shows the number of price cuts in our MLS and the Canopy and MLS. 1,300 in April, they went up to 1,500, 2,100. You can check the same thing on your MLS. You can do these numbers every day. You can see that the prices are start to coming down already. Commercial real estate, very promising. NAR believes that 2022 is going to be a good year as people get vaccinated and return to jobs, and people start traveling again. Commercial business is going to pick up. Right now, as far as property valuation, we're almost where we were before pandemic in February of 2022. If you look at this chart, we're less than 1% as far as prices. So it recovered pretty quick. That was it for me, Sarah. I'm just going to pause for a second and see if there's any questions before I introduce our next speaker.
Any questions, guys? Everyone still there? Okay, good.
Great. Well, I know it was a lot of information in a short amount of time. I'll make these slides available to share with everyone if you guys like to review them and look at them. Some of them could be good information to educate your clients. But I'm going to introduce our next speaker, Carmen Mercado. She is the Senior Affordable Lending Manager at FreddieMac. So tell you a little bit about Carmen. She's responsible for building and managing industry relationship as part of the affordable lending team. Sarah's goal is to make awareness in the community about FreddieMac's offering and what they can do to make basically home purchases more affordable and offer affordable lending options. So we're really happy to have you here, Sarah. Carmen, welcome, and I'll let you talk and tell them a little bit about your program. Let me put myself on mute.
No, absolutely. Thank you, Kourosh and Sarah and Hadi, for inviting FreddieMac to be here. We've had a partnership with RE/MAX for several years at this point, and that's through Mike Reagan, right? He's a phenomenal partner of ours. Today, I'm going to present a lot of information. I know that you have received great information from Kourosh, so I wanted to kind of pivot a little bit and take a look at the millennial population as it pertains to opportunities in the market. I've also invited Alex, which all of you most likely are very familiar, to kind of dive into some of the grassroots, right? Because when I like to present information, I like to present it in a way that is going to actually make sense for you from a business perspective and how you can incorporate some of the information you're hearing into actually business opportunities. So with that, I want to make sure I'm going to share my screen, and hopefully just give me a thumbs up when you can actually see my screen. And Sarah, are we good with the screen? Perfect, thank you. So let's go ahead and let's start diving into some of the information as it pertains to what we call leading the home. What's the future of home ownership? So let's go ahead and move forward and just make sure, because I'm getting some pop-ups here, so I apologize. Let me Okay, here you go, Sarah. For some reason, the video left out. So before I get started going into the data, I started with FreddieMac about 3.5 years ago. I actually come with a real estate background. I was, selling real estate, managing offices. So real estate agents in particular have a special place in my heart because I know that you are at the grassroots level. But FreddieMac does not work directly with your buyer, right? We work with our lending partners. We're in the secondary market, and what we look to do is really provide stability and liquidity in the market. How we do that is by purchasing loans from our lenders and then going into the secondary market and finding investors for those loans. That helps the lenders continue to provide liquidity and make more mortgages out to your buyers. So although we don't participate every single day into your transaction, if the lenders do follow our guidelines, they are able to sell those loans back to us. So a lot of people ask, well, why is FreddieMac reaching out to real estate professionals? Because the more you know about what's available, especially in a market where a lot of low to moderate income buyers are really struggling and first-time home buyers because of the data that you just heard from Kourosh, right? The tightening of the affordability index. But let's go ahead and take a look at what FreddieMac has done overall. In a market where we needed to provide liquidity, you see that we provided a little bit over 1 billion liquidity into the market. And what we also did was actually help about 3.8 million buyers either refinance, homeowners, or purchase properties. So that's really important to FreddieMac. And one of the other things that we did, and many of you may have seen us in different forums, is we responded very quickly to forbearance options for anyone who was a homeowner with a FreddieMac owned loan. And we still have an entire Help Starts Here campaign focused on individuals who were impacted by COVID so that they can actually stay in place, stay at home, and look at some of the forbearance options that they may have. So we're a really important part of what we like to call the housing ecosystem by providing the stability and liquidity. We also look at our data team. We have a phenomenal market and data analytics team at FreddieMac that provide us some of the slides we're going to be sharing with you today. We also have a chief economist office, and Kourosh, thank you for sharing some of our data on your slides in terms of the forecast and interest rates as well as housing appreciation. Although we are seeing those shifts that you shared, Kourosh, we really feel that's still a good opportunity for real estate agents to look at not only the millennial market as future buyers, but also take a look at their past customers for refinance opportunity. And Alex, I'll be bringing you into that conversation in a little bit. But let's go ahead, and what you're seeing on the slide right here is that the millennial population has already surpassed the baby boomer population. And you're seeing the slides on the screen will show you the different ranges within that millennial cohort. Right, so you have your older millennials, those are between 35 and 38 years old, that are making life decisions that are leading them to purchase property. So you're seeing that as you look at the NAR member and buyers and sellers profile, that report is phenomenal, by the way. I would definitely pull the whole report. You see that marriage is a direct correlation to actually purchasing properties. Married couples by far over index any other cohort purchasing actually properties on that buyer and seller profile. But what you're also seeing in that buyer and seller profile that NAR has to offer is that the younger cohorts actually making up the first-time home buyers are actually falling within that 29 years or younger category. So take a look at what's driving that. You see that the older the millennial age ranges, then you see the lighter blue shows the married and those that are single. So what you also saw, it's not here on the slide, but it is available on the NAR. It shows you that married couples are the largest cohort of purchasing properties, but the second cohort, I actually would love to see your interaction on the screen. Who do you think is the second, outside of married couples, who's the second biggest cohort in terms of purchasing properties? So if you've seen the NAR study, you will know the answer to that. There's no right or wrong. It's just trying to make it interactive here with all of you. But the second largest is actually single females. So if single females are not on your radar, they should be because it is the second largest group of all purchases based on that NAR profile that was shared. So let's go ahead and take a look at millennial. It's on an uptick. about 49% in 2020. That's a good indicator that millennials are starting to make those life decisions to purchase properties. And sometimes, there has been a stigma for so many years that millennials aren't looking for property. Yes, they're making life choices at a later stage in their life and compared to baby boomers, but they are already of age. So we have to think of millennials from a different perspective, not bunch them all together, right? Because we do have older millennials and even those that are 29 years or younger making decisions to actually purchase property. What you're seeing on this screen, it really just shows you those mortgages that were acquired by Freddie Mac. Remember, I said we don't lend directly, but when you have, lenders like Alex and they're working with your buyers, and then those are sold to Freddie Mac, we're seeing that percentage of millennials of loans that we purchased was a lot higher. That was at 51.9%. Again, really driving the message of what you're seeing at the NAR member, buyer, and seller profile. I wanted to pull in these two slides. I added them last minute, and the reason I did it is because we're talking about millennials. I wanted to give you a kind of an example of the opportunity, right? I like to talk about opportunity. So if you look at the US column, as I'm moving my mouse on the screen, keeping that kind of millennial cohort, 34 years old, you can even go to 35 to 44 because you get up to 38. You see how North Carolina is comparing to the overall US. And you see there are markets, in some of the larger MSAs within North Carolina that are either higher or lower within that particular demographic group. So the reason I say that is because these are the opportunities that are available for you to reach the millennial population. This is a similar chart. This is just comparing South Carolina, and what it shows you that there are a higher percentage of people in Charleston who fall within that millennial cohort, 25 to 34 years old. And you will also get a copy of my slides, so you'll be able to take a look at that. So again, it's reshifting our mindset that millennials are still a really viable solution for future home buyers. I do want to pause. I know that, affordability is being crunched for sure. One slide that I don't have on here, but I know, Kourosh, you mentioned it briefly in your conversation in terms of the purchase market. Actually, we have looked at data of migration patterns, so where are folks leaving, outbound migration, as well as inbound migration. And actually, South Carolina and North Carolina made the top 10 of inbound migration. People living some high-cost markets, you would, no surprise, New York City, California, were on the higher markets in terms of outbound because of affordability. So let's take a look at what can you do with millennials who are looking to purchase properties. All buyers, not only millennials. We at Freddie Mac create guidelines for loans that our lending partners can leverage. So we're going to talk a little bit about some of the solutions. We know right now that there is a crunch on affordability, multiple offers on the price. I'm hearing from many of the real estate agents out there above asking price. So sometimes you have your buyers that, although they may have more than 3% down payment, have to use that down payment differently to actually secure that property. So we want to talk to you about briefly two products. And, again, I'm going to bring Alex into the conversation so that he can share his experiences with these products and how you can leverage this information to help more buyers be able to secure their loan. So at Freddie Mac, we're focused on what we call low to moderate income buyers. So those are individuals that are making 80% or less of the average median income. And we'll share with you where you can find that information, as well as Alex and others can help you find that information for your particular market. But when we look at Home Possible, that loan specifically is a conventional loan. A lot of people hear Freddie Mac's Home Possible loan 3% and get it confused with FHA. The reality is that FHA is a 3.5% loan. Freddie Mac's Home Possible is 3% for those making 80% or less of the average median income. What it also allows them to do is that the mortgage interest calculation is lower than your standard conventional loan. And the reason for that is this particular product is focused on low to moderate income buyers, as really breaking down that barrier point of entry level, which many times is that down payment. The other thing about Home Possible that differs from FHA, as an example, is that the mortgage insurance premium can be canceled. Once they have 78% equity, automatically will drop off. But if at 80% equity, they reach out to their servicer, they can request that mortgage insurance premium to be removed from that payment, saving that buyer or that homeowner at that point, saving that homeowner a lot of money that they can use either to just be in a better position financially, or maybe even start saving towards college, or maybe even a second home. So these are some of the differences. The other difference between Home Possible and the FHA partner, the comparison, is that the MI upfront premium. So Alex, you know this, right? With FHA, there's an upfront premium. Most individuals that have to use a low down payment option will have to finance that premium into the life of the loan. Therefore, they're paying more because they're paying interest rates on that as well. So these are some of the comparisons of Home Possible in terms of the affordability for this particular product. And here is just a side-by-side comparison of kind of what I went through with you throughout the process. So, Alex, I'm going to pause here before going into our other product, which is also a low down payment option, and see if, you can share maybe some of your experiences of having used Home Possible with, some of the buyers that the real estate agents and you have worked with. So, Alex, if you can unmute yourself and maybe share some information, because I would like to really get some grassroots level conversation here, Alex, from your perspective.
Sure. Thank you so much, Carmen, for introducing me. I hope everybody's doing well this morning. Just from our perspective, we love Home Possible. We think it's a superior product to the Fannie competition from that regard, not only because of the superior education through Credit Smart University, and as well as that piece being free. It's also a little bit better and a little bit more informative than the Fannie counterpart. But overall, we try to put as many buyers with low down payments as possible into FreddieMac Home Possible. Just like some of these benefits that Carmen has kind of gone over in the slide, what we generally find is that the interest rate would be lower than the other product that Carmen's referring to, which is Home One, which we also use quite a bit for folks that make too much for the Home Possible program. But the interest rate is better. The mortgage insurance is much lower than FHA. So if possible, depending on credit score, we try to put folks in this Home Possible box. I've put a number of millennial buyers, as Carmen has mentioned, even some Gen Zers recently into there. I will say it's gotten a little bit more difficult recently, going down to 80% medium income. A lot of times, though, we can be more creative on the underwriting side and take advantage of maybe isolating one borrower of the couple if there's two people buying, excluding some overtime or extra income. That's allowable under guidelines. But we truly like the FreddieMac Home Possible program. The rate is a little bit better, like we said, than a 3% down conventional program. And a lot of times, investors that we work with that ultimately sell to FreddieMac run pricing incentives on Home Possible as well.
No, thank you, Alex, for that. And the reality is that, as Alex mentioned, it's not going to be a product for every single buyer that you have. But I also want to make one point here. With Home Possible, they actually do not have to be a first-time home buyer. They actually can leverage this as if they have another property, they can have 2 properties. And the other thing is that they actually can also do a no cash out refinance. And with interest rates being so low right now, this is a great conversation for you to reach out to your past customers and see if they want to tap into that equity to remove an MI if they currently are in a mortgage that has MI for the life of the loan. So, these are just all conversations. The other thing, what you're seeing here is that Home Possible is not just for a single family unit. They actually can purchase up to a 4-family unit and still qualify for Home Possible. The deposit or down payment increases, as you can see, 85 LTV for 2-unit, which is loan to value income ratios, and for 3 to 4, it has to be 75 LTV. But what this does allow is, from an affordability standpoint, for individuals to maybe think outside of the box, as well as multi-generational households coming together. Another difference here is how we calculate student loans. There's other products that out there that will calculate automatically a 1%. If the student is paying less than 1% and they can show that on their credit report, the lender can actually use that amount to qualify them for that loan. So it really opens up a little bit more of the affordability box if they do carry a student loan, because our calculations are slightly lower. They do require education. Alice, you mentioned that briefly, and I'll talk about that in a second. But it is requires home buyer education. But what we did to make it a little easier, we actually provided that home buyer education at no cost for any buyer who is leveraging an actual Home Possible product. So again, Home Possible ratios, as you can see, it's a 1 unit. It continues to go up if you're buying a 2, 3, or 4 unit property, but it's still, the MI is still removable. Again, think of Home Possible for low to moderate income buyers as a purchase option, as well as a refinance option. So it looks like my screen may have frozen, so just bear with me for a minute. I'm trying to get that to move for you. So give me 1 second. I apologize for some. Just if for some reason my screen froze, so I'm going to try to reshare here in a second, so just bear with me. Okay, technology is only as good as it's worth at the moment. For some reason, we're having technical difficulties. So just give me 1 second. I'm going to share it one more time. Let's try to get that and see if I can get this moving for you. So my apologies. Okay, technology, let's see. Okay, there we go. So thank you for your patience there. So this is the Home Possible. Now, this is the mortgage insurance premium, which I talked about. Again, you can see it's calculated at 25%, which is much less than what you're seeing out there on the conventional side. The other thing I wanted to talk about was really Home One. And Alex, you talked about this briefly. I want to give you some of the differences between Home Possible and Home One. So Home One is also a 3% low down payment option for your buyers. The difference is that they do not have any income limitations. So if you have a buyer that is making above that 80% LMI, they actually can go ahead and qualify for Home One. Alex, you did mention this. The cost is a little bit more, but still an affordable product, because they actually can still remove the MI. They can still only put 3% down payment. It is your standard conventional mortgage insurance premium. So it is not the first choice. If you have individuals that fall underneath that LMI, you definitely want to, speak to your lender about putting them into Home Possible loan. But if they do fall above that, Home One is still a great option, is still an affordable option for them. So I like to say that Home One and Home Possible look almost identical to each other. Some of the differences, again, is that there's no geographical or income limitations for this product. It just was one of FreddieMac's ways to broaden our reach, because we know that one of the biggest barriers is the down payment, regardless of how much income they're making. In some instances, depending on the cost of the market in which they're living, it could take someone, 20 years and more to save 20% down payment. So this particular product will help alleviate some of that, even for the higher income earners. So we were very excited to put that product about 2.5 years ago, give or take. When you take a look at the Home Possible eligibility, this is something that Alex can help you with. If you're kind of a DIY person, you like to kind of go in there and check things for yourself, you can go to the FreddieMac.com website, and there's an income eligibility tool. You can do this for your listings. You can do this for a buyer that you're working with on a property. And what you're going to do is you're going to enter an address right there in that little field that you see. And when you enter the address, it's going to let you know what the Home Possible income limit is for that particular address. So in this case, I put our McLean, Virginia office, which is where our corporate headquarters are housed. And in McLean, Virginia, the income limit for Home Possible would have been $95,920,000. If they made more than that, then they would have to go ahead and go into a Home One product. But if they made less than that, they can actually leverage Home Possible. The other really good thing about Home Possible is that they can actually couple that with a grant or a second soft loan. We have to take first lien property, first lien position, but they actually can use this with grants and other programs that are out there. So therefore, when you go to the income eligibility tool, you're going to see there's a link to a down payment resource page. That down payment resource page is going to allow you to find out what down payments are available locally, regionally, and it'll be very interesting to see, because I've tested this on my home address just to see what was available. And there are some small grants that maybe you and your buyer were not aware of. Some of them are required to be in contract. Some have to be out of contract before they're required submit for a down payment resource. But please take a look at this as a great resource. Another thing that we are also really happy to be, Alex, would love to hear your, kind of your conversation on this. But when you look at self-employed, the way we look at self-employed also has been made easier for our lenders to be able to process self-employed. And as realtors, you all know very well that sometimes dealing with self-employed buyers, it could be very challenging. So Alex, any comment on that before we move along? Just want to be respectful of the time.
Oh yeah, absolutely. I think FreddieMac's been leading the way the past few years, especially just with allowing us to qualify more self-employed borrowers, mainly because if they've been in the business 5 or more years and can have that verified by a third party, we can usually only take 1 year tax return. So if they've had a better 2020 versus 2019, or maybe they filed taxes mid-year and their tax years, July to July right now. That's all something that's kind of run in the loan product advisor that FreddieMac does for their underwriting decision-making, but we can definitely qualify a lot more borrowers and have qualified a lot more borrowers using that option, as well as most of the time there's less asset documentation requirements as well when we run, desktop underwriter as well as loan product advisor at the same time. For self-employed and other borrowers, Freddie offers a lot more advantages using their program and their underwriting guidelines.
Thank you, Alex, which leads me to the slide that you're seeing right now. And you talk loan product advisor, that is really a lender jargon, right? Because that's what they use to be able to make sure that they're following the FreddieMac guidelines so that they can actually sell those loans. But we actually have really developed capabilities to automate that process. As you heard from Alex. So the reason for this is to automate the asset and income so that they can get quicker decisions on whether that borrower or that buyer can actually qualify for any particular loan. The other thing was the self-employed, Alex, so thank you for mentioning that. How we look at self-employed also is just really making the process less complex for our lenders that are working with us, so that ultimately they can let you know and give you a faster decision. Another thing I wanted to talk about briefly was, right now, especially in this market, you have a lot of appraisal waivers that are going on automatically because they're just trying to secure the property. FreddieMac actually has an option for certain buyers and in certain markets. So if Alex puts in the loan through the loan product advisor, he will get a decision whether or not that particular loan can receive what they call an appraisal waiver. What that means is that FreddieMac would purchase that loan even if it did not have an independent appraisal. And some people may be like, well, why are you doing that? The reality is that we're getting information from a lot of sources, and we feel comfortable that we can purchase that property without an actual appraisal. So this is something that is available also for condominium units. And this has really allowed the buyers to save money and as well as expedite the process. They have the choice. They can still have the automatic appraisal if they want to on their own. But if they do get what we call an automatic appraisal evaluation waiver, then they can let you know, okay, we're going to bypass the appraisal. We're comfortable with that, and save them money and also save them some time. What you're seeing on the screen is, this is kind of like what we call the appraisal model. And this is the repeat sales, is looking at repeat sales, is looking at prior appraisal information, public records, so that they can make that decision internally and feel comfortable with that. Again, your buyer still has the option to have an appraisal done, but they actually can waive it as long as Alex or the lender that's working with them actually gets that appraisal waiver notification. So what I'm going to close up with, we have a minute left at our session here. I want to leave you with a couple of ways that you can interact with FreddieMac. If you want to go to our FreddieMac website, you can actually go to the down payment resource tab and look within your zip code what's available. We also have consumer facing website, which is My Home. This is a great tool for you to share with your network. We don't publish any or advertise any lenders or any real estate companies. It is truly educational, and you can share this on your social media feeds. It's a great resource for renters, buyers, or even homeowners looking to prevent foreclosure. What you're seeing on the screen now is the educational component that Alex talked about. If they are purchasing a Home Possible or Home One, they can go and take our Credit Smart Home Buyer U, and once they're completed with their course, they can send a certificate of completion via email right from the course to both you, the real estate agent, and the lender, letting them know that they've completed that course, keeping you in the know that they've satisfied that mortgage requirement for that loan. Additional to that, we have a lot of insights and data. There's a full Millennial Playbook and other playbooks that you can download from our site at no cost to you. I encourage you to go and take a look at that. We also have training courses for real estate professionals. And in order for you to be in the know, you do need to subscribe for our Real Estate Professionals Resource Center. There's no cost. We do not spam you. It is 100% educational, and you can download some of our mortgage interest rate forecasts and tons of reports that are available and shareable on your social media feeds. So with that, I just wanted to make sure I stayed within my time. If I have any questions, Sarah, please let me know. I will also put in the chat my contact information. We will make these slides available to you, but thank you for the opportunity, and thank you, Alice, for joining me today.
Thank you, Carmen. Thanks for looping me in.
You're welcome.
Awesome. Thank you so much, Carmen and Alex.
Any questions, Sarah, on the chat box?
So there is one question real quick. To remove the MIP, is there a seasoning requirement for any buyer?
Great question. Typically, it's about 7-year requirement, but if they're able to show that they have the equity because of the appreciation levels that we're seeing, at least 5 years. So they can go ahead and call their servicer at least once they're in the house for 5 years.
Awesome.
Okay, great. I think, thank you so much. And you have all the information. I think Sarah put it on the chat box. If you have any further question or answer or inquiry about this particular program with Fannie Mae, feel free to contact. And